Welcome to the Explainer. Today, we're diving right into a massive, high-stakes question. Can $95 to $110 oil actually turn a highly speculative microcap into a major winner? Let's find out. So, the company in our crosshairs today is Battalion Oil, trading on the NYSE American under the ticker BATL. This is an incredibly commodity-sensitive equity with a pretty small operating base. To put that into perspective, they ended Q2 of 2026 producing roughly 12,407 barrels of oil equivalent per day. That generated about $48.1 million in revenue. But, the defining characteristic here? They are highly leveraged, meaning their overall debt load is absolutely massive compared to their actual size and cash flow. It's basically a financial high-wire act. Because of this outsized debt burden, this isn't your conventional, sleepy buy-and-hold oil investment. Not at all. It is a textbook, high-risk, high-reward speculative buy. The leverage acts like a giant amplifier. It offers exceptional upside when oil prices rise, but exceptional, crushing downside when oil falls. Now look at their production profile. This right here is exactly why Battalion Oil is so exquisitely sensitive to crude price movements. They aren't just pumping natural gas. Approximately 45% of their production is oil, but you've also got to factor in that 25% chunk of other liquids. Those natural gas liquids often track really closely with crude pricing dynamics. So when you combine the two, a full 70% of their output is liquids linked. That's the engine here. Their economic success doesn't hinge on natural gas. It is completely tethered to higher crude prices and stable or increasing production volumes in those liquid categories. Why are we even talking about a potential surge in oil prices right now? It really comes down to the current geopolitical environment, specifically the simmering tensions involving Iran and the Strait of Hormuz. We're not just talking about normal, everyday cyclical oil price fluctuations. A prolonged disruption in the Strait of Hormuz creates a massive bottleneck. It hits global crude exports, refined product shipments, tanker availability, and inevitably drains global inventories. This creates a huge asymmetric supply risk. And here's why that matters so much for a domestic producer. When global supply is constrained, international benchmark prices absolutely spike, pulling domestic benchmarks like WTI right up with them. So producers like Battalion Oil, safely operating onshore in the U.S., suddenly receive substantially higher realized prices for their heavily liquids-linked production. They capture a massive geopolitical premium without taking on the actual physical geopolitical risk. Now, the crucial point here is how we frame our expectations. Honestly, it's a fundamental mistake to build an investing thesis assuming oil will average $110 perpetually. As the saying goes, the cure for high prices is high prices. Shale producers ramp up, EV adoption accelerates, and governments release strategic reserves. Instead, the absolute most realistic and vital question we need to ask for this thesis is this. What happens to Battalion Oil if West Texas Intermediate, or WTI, averages $95 to $105 for the next 12 to 24 months? That specific, constrained window is the absolute time frame that matters most for this company right now. If that price window holds, we've got to look at the balance sheet. And honestly, here is the first piece of genuinely excellent news. Between Q1 and Q2 of 2026, Battalion Oil's net debt absolutely plummeted from over $108 million down to just $74.2 million. Taking over $30 million off the debt load of a microcap company in a single quarter is just astonishing. This balance sheet repair is arguably the most important positive development in the entire Battalion Oil story right now. But keep in mind, a debt reduction of this magnitude for a company of this size doesn't just come from selling a few extra barrels of oil. The mechanism behind this payoff is exactly what sets up the fundamental tension of this whole investment. See, this debt reduction isn't happening in a vacuum. It completely reshapes their broader financial stability. Because of that aggressive debt paydown, their leverage ratio drops significantly, moving from 1.79 times down to a much more manageable 1.36 times. On top of that, they use this momentum to successfully refinance their term loan. This new senior secured facility extends their debt maturity all the way out to December 31st, 2029, and provides up to $175 million in discretionary delayed draw capacity. Simply put, this maneuvering massively reduces the immediate existential risk of financial distress. Basically, they bought themselves time. But as with pretty much all high-risk plays, that financial relief and that extra time came at a massive, massive cost to existing investors. $32.3 million. Just take a second to let that number sink in. That is the staggering amount of new shares Battalion Oil issued across Q2 and shortly after the quarter ended. They sold 17.4 million shares during the quarter for about $30 million, and another 14.9 million shares right after for $25.6 million. For a microcap company with a tiny initial equity value, issuing over 32 million new shares isn't just a capital raise. It is an enormous, heavily dilutive fundamental shift in ownership. This really highlights the dual nature of their $150 million at-the-market or ATM equity program. An ATM is a mechanism where the company sells shares directly into the open market at prevailing prices. On the one hand, it's undeniably positive for corporate health, right? It provides the vital, immediate capital needed to reduce debt, improve liquidity, and actually fund operations so the company can survive. But on the other hand, it's incredibly painful for existing investors because every single new share printed means you now own a rapidly shrinking percentage of the company. It's a brutal, zero-sum trade-off between baseline corporate survival and actual shareholder value. And, we see this exact same double-edged sword with their preferred equity restructuring. Battalion extinguished about $42 million of preferred liquidation value. That's essentially paying off a specialized, expensive class of investors who had a prior senior claim on the company's assets before common shareholders could ever see a dime. Getting rid of that, great move to clear a heavy overhang on the capital structure. However, doing so cost them $19 million in cash, plus they had to issue yet another 3.5 million new common shares. So again, reducing the structural burden is ultimately a huge positive for the entity itself, but common shareholders are once again the ones absorbing the blunt force punishment of additional dilution. But hey, there is the light at the end of the tunnel here if management can execute perfectly. An imminent catalyst is upon us. Under a new joint exploration and development agreement, a new drilling program was expected to kick off before the end of August 2026. This is vital, not just for growth, but honestly, simply to offset the steep natural decline rates that are typical of existing shale oil wells. In this industry, if you aren't drilling, you're shrinking. The ultimate bullish scenario for this company isn't just surviving on high oil prices with flat production. The absolute dream scenario is high oil prices combined with newly rising production volumes and declining debt. This new drilling program is the engine that could transition Battalion from a mere survival story into a massive free cash flow generating machine. Let's methodically break down the exact risk-to-reward ratio based on the price of crude. This really shows how nonlinear this investment is. If we're looking at $60 to $65 a barrel, Battalion is under severe pressure. It's a highly bearish environment where their cash flow barely covers obligations. At 70 to 75, they survive, but margins are razor thin, and you have to be highly cautious. But look at what happens as we move up the ladder. If oil sits in that 80 to 90 range, economics start improving. If it climbs to the $90 to $100 range, it becomes a strong, bullish environment where debt reduction accelerates organically. And if we hit that $110 to $125 range because of prolonged geopolitical tensions, we're looking at a potential windfall, making it extremely bullish. Because of their debt structure, the leverage to the upside here is staggering. Every dollar increase in oil flows almost directly to the bottom line once baseline costs are met. So how does a speculative investor actually make a massive multiple, let's say a 5x return on this stock? Well, it's not easy. It requires a very strict 5-step blueprint to unfold almost simultaneously. First, oil must stay firmly above $90, preferably much higher. Second, the new drilling actually has to work, pushing production to grow toward 14 or 15,000 barrels of oil equivalent per day. Third, debt has to keep plummeting using organic cash from those high commodity prices, not from selling stock. Fourth, and this is absolutely 100% critical, the rampant share dilution must completely stop. And fifth, the broader market needs to finally shift its psychological view of the company. Right now, the market is pricing Battalion as a distressed survivor, applying a heavy discount for the constant dilution and debt anxiety. To get a massive return, the market has to transition to valuing Battalion based on its forward free cash flow, applying a standard industry multiple to a now healthy balance sheet. But look, we have to be completely, coldly objective here. What destroys this thesis entirely? Let's start with the macro environment. A sudden collapse in global oil prices is for sure the single biggest external risk. If crude plummets, that leverage works in reverse and crushes them. But running a really close second is the internal micro risk, relentless equity dilution. If management keeps printing shares at the current rate to fund operations, your slice of the pie just vanishes, regardless of what oil does. Then you've got the operational risks typical for small producers who just have far less margin for error, fewer rigs, and less capital than the super majors. Finally, returning to the macro picture, if the geopolitical situation normalizes and the Strait of Hormuz risk disappears, the fear-driven premium on oil evaporates overnight, and this entire high-price commodity cycle could reverse incredibly quickly. There's also a hidden structural danger in the financials that you absolutely must be aware of: the hedging problem. In the first half of 2026, Battalion reported a $34.9 million net loss on derivative contracts. That $34.9 million represents real cash and massive opportunity cost flying right out the window. Financial hedges are specifically designed to protect a highly leveraged company when prices collapse, ensuring they can still pay their debts. But they come with a brutal trade-off. They essentially act as a hard ceiling when prices explode. So if you're buying this stock expecting a massive, unmitigated windfall from $110 oil, you need to deeply understand that Battalion might not receive the full economic benefit of every single dollar increase simply because those historical hedges cap their upside. Let's contextualize this with an analytical probability framework. Based on the data, there's about a 25% chance of a bear case, where WTI falls below $75 and the company struggles with significant financial downside. The most likely scenario, sitting at 45%, is the base case. Here, WTI averages $80 to $95, resulting in moderate asset appreciation but high choppy volatility. But the entire allure for speculative investors lies in the tail risk, the 25% bull case, where production actually improves and dilution slows down, and especially that elusive 5% extreme bull case, where explosive upside is unlocked by prolonged geopolitically driven oil spikes. So you really have to ask yourself, are you willing to endure a 45% chance of massive chop and a 25% chance of straight up losing money just for a 5% chance of an absolute moonshot? Which brings us to what is perhaps the most crucial takeaway of this entire explainer. Let's call it the oil paradox. It is the simple, frustrating reality of microcap investing. Oil can go up, the company's internal cash flow can genuinely improve, and the overall enterprise value of the business can increase. But if management continues their massive equity issuance, that dilution determines whether you, the individual common shareholder, actually make a single cent. You could be 100% right about the geopolitical macro oil thesis, predicting a massive crunch in the Middle East perfectly, and still underperform the market if the share count keeps exploding underneath you. Ultimately, this all culminates in our final scorecard. Battalion Oil gets 5 out of 5 stars for sheer oil leverage and 5 stars for theoretical upside potential. However, it identically earns 5 stars for severe dilution risk and a very low 2 stars for overall predictability. The verdict? This is absolutely not a normal buy-and-forget long-term core holding. No way. It is a highly analytical, high-risk satellite position built entirely around a bullish, constrained supply oil thesis playing out over a very specific 1 to 3 year window. So, I want to leave you with this final, provocative thought to consider. The stock's current market valuation is tiny relative to the millions of barrels of underlying reserves in the ground, but this is an asymmetric speculation, not a guaranteed multi-bagger. You really have to ask yourself honestly, can your portfolio genuinely stomach extreme daily volatility and massive corporate dilution for the outside chance at a geopolitically driven oil windfall? Think very carefully on that risk tolerance, because in the high-stakes world of leveraged microcap oil, the ride is literally never smooth.